Stock investing, when done well, is among the most effective ways to build long-term wealth. In this video, we will guide you step by step to investing money in the stock market to help ensure you're doing it the right way. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. Determine your investing approach. The first thing to consider is how to start investing in stocks. Some investors choose to buy individual stocks, while others take a less active approach. The different ways to invest in the stock market include individual stocks, index funds, and many more. Individual stocks. If and only if you have the time and desire to thoroughly investigate and continuously assess stocks, you can invest in individual equities. If so, we wholeheartedly urge you to take action. A wise and persistent investor has a good chance of outperforming the market over time. On the other hand, there is absolutely nothing wrong with adopting a more passive strategy if things like quarterly earnings reports and straightforward mathematical computations don't sound appetizing. Index funds. You have the option to invest in index funds, which follow stock indices like the S&P 500, in addition to purchasing individual equities. Although there are obviously exceptions, we generally favor passively managed funds over actively managed ones. The fees of index funds are often far cheaper, and they almost always reflect the long-term performance of the underlying indices. The S&P 500 has generated total returns that have averaged 10% over time, and performance like this can generate sizable wealth over time. Number 2. Decide how much you will invest in stocks. Let's start by discussing the capital you shouldn't put into stocks. Money that you could need within the next 5 years, at the very least, should not be invested in the stock market. Even while the stock market will almost surely increase in value over the long term, there is just too much uncertainty in stock prices right now. In fact, a decrease of 20% in any given year is not unusual. During the COVID-19 epidemic in 2020, the market fell by more than 40% before quickly rising to an all-time high. Asset allocation. Let's now discuss what to do with your investable funds, or the money you are likely not going to need in the upcoming 5 years. Asset allocation is a notion that applies to this situation, and several variables are involved. Your age, unique risk tolerance, and investment goals are all very important factors. Starting with your age. The conventional consensus is that stocks eventually lose appeal as you age as a place to invest your money. If you're young, you have decades to ride out any market ups and downs, but if you're retired and dependent on your investment income, this isn't the case. Here is a brief guideline that can help you approximate your asset allocation. Add 110 to your age, then subtract it. This is roughly how much of your investable funds you should put into equities. Bonds or high-yield CDs should make up the remainder of your portfolio. This ratio can then be changed based on your personal risk tolerance. Number 3. Open an investment account. If you lack the means to purchase stocks, all the novice stock trading information in the world won't help you much. You will want a particular kind of account known as a brokerage account to do this. Companies like TD Ameritrade, E-Trade, Charles Schwab, and many others provide these accounts. Additionally, establishing a brokerage account is often a simple, quick process that takes only a few minutes. EFT transfers, postal checks, and wire transfers make it simple to finance your brokerage account. Opening a brokerage account is typically simple, but you should think about a few factors before selecting a broker. Type of account. Choose the sort of brokerage account you require first. This involves selecting between a basic brokerage account and an individual retirement account for the majority of people who are just beginning to explore stock market investing. You are able to purchase stocks, mutual funds, and ETFs using either type of account. The primary factors to take into account here are your investment objectives and how simple you want it to be to access your funds. A conventional brokerage account is probably what you want if you want quick access to your funds, are only saving for a rainy day, or wish to invest more than the yearly IRA contribution maximum. On the other hand, an IRA is a terrific choice if your objective is to amass a retirement nest egg. Traditional and Roth IRAs are the two basic types of these accounts, and there are also some specialized IRAs for self-employed people and small business owners, such as the SEP IRA and Simple IRA. Although IRAs offer excellent tax advantages for stock purchases, it may be challenging to access your funds until you reach retirement age. Compare costs and features. Since most internet stockbrokers have done away with trading commissions, most of them are competitively priced. There are, however, a number of additional significant variations. For instance, Some brokers provide their clients with a selection of learning resources, access to investment research, and other features that are particularly helpful for novice investors. Some allow trading on international stock markets. Additionally, some have physical branch networks, which is advantageous if you want in-person investment advice. The trading platform of the broker's user-friendliness and functionality are additional factors. I've used a good number of them, and I can attest that some are significantly more clunky than others. Many will allow you to test out a demo version prior to making a purchase, and if that's the case, I strongly advise it. Number 4. Choose your stocks. Now that the how-to question has been resolved, here are 5 excellent stocks to get you started if you're searching for some terrific beginner-friendly investment ideas. Of course, we can't cover all you should think about while choosing and analyzing stocks in just a few pages, but these are the key ideas to understand before you begin. Increase portfolio diversity. Invest only in companies you fully comprehend. Till you master investing, stay away from stocks with significant volatility. Avoid penny stocks at all costs. Learn the fundamental ideas and parameters for stock evaluation. It's a good idea to understand the concept of diversity, which states that your portfolio should contain a range of different types of businesses. I would advise against diversifying your business too much, though. Stay with companies you are familiar with, and if you find that you are adept at analyzing a certain class of stock, there is nothing wrong with having a sizable portion of your portfolio dedicated to that area. It may seem like a terrific way to increase your wealth to invest in glitzy high-growth stocks, but I'd advise you to wait until you have a little more experience before doing so. It's better to build your portfolio's foundation around dependable, seasoned companies. Learn some of the fundamental methods for assessing particular equities if you want to invest in them. An excellent place to start is with our Value Investing Guide. There, we assist you in locating equities with appealing valuations. And our Guide to Growth Investing is a terrific place to start if you want to add some exciting long-term growth prospects to your portfolio. Number 5. Continue investing. Here is one of the most important investment secrets, courtesy of none other than Warren Buffett, the Oracle of Omaha. To get remarkable results, you do not need to do unusual actions. Not only is Warren Buffett the best financial strategist of all time, but he is also the most successful long-term investor of all time. Investing in shares of successful companies at reasonable prices and holding onto them until you need the money or the company's continued success is the most reliable strategy to make money in the stock market. This can result in some volatility along the way, but over time, you'll generate good returns on your investments. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.